the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market ended the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. While Singapore shares moved higher earlier today to track the previous day's gains. So the Straits Times Index was up 0.29% at 3,843 points at about 11:49 a.m. Singapore time. And that is with a value turnover of some 667 million Sing dollars seen in the broader market. Now, as we shared with you earlier, the STI gave up those gains, closing marginally in the red. We're looking at the STI closing down 0.01%, almost flat at 3,831 points. In terms of value turnover, that's 1.6 billion Sing dollars at the end of the trading day. Gainers trailed losers 260 versus 271. Top advances for today we've got for you SGX, GMHUSD and Jardine Cycle and Carriage, and top decliners Yangzijiang Shipbuilding CNY, DBS and UOB. Now, in terms of counters to watch, we have Keppel, because Keppel released an update for Q1 2025 today, reporting an increase in net profit of over 25% year-on-year. Now, elsewhere, the Trump administration reportedly considering reducing tariffs on auto parts. And also on deck, what should we expect ahead of Alphabet's earnings release due in the early hours of tomorrow? Lots to watch, and joining me on the line on a Thursday is David Chow, Director at Azure Capital. David, welcome.
Hi, Tian. Hi, everyone.
Great to have you on board, and lots to unpack today. So very quickly, Let's start with the STI. How did it fare today? Any surprises when it comes down to the biggest movers?
We're definitely seeing a more filtered STI performance today, with the index opening higher, but, gradually powering down its gains throughout the trading day, and finally it closed lower as 0.1% or flattish, as you had earlier put it. I think at present moment, we are really getting mixed signals from the Trump administration. On one hand, market enthusiasm got curbed, after the Treasury Secretary, Scott Bessent, casted doubts on the timely resolution to the U.S.-China trade wars, and then I think as we speak, there are headlines hitting the market now with news coming from China saying that no, they have not received any invitation from the U.S. To discuss this, to reach a resolution. So these are signs that probably are leading the U.S. Futures down at the moment. So at this moment, we definitely find it hard to forecast where the markets are headed. Amid all these headlines from various officers in the administration and frequent back and forth by Trump on his tariffs. And on top movers for the market today, we still see the likes of market favorites for now, SGX and ST Engineering being featured prominently, So even as the financial sector faces headwind from all these tariffs, SGX has somewhat, bucked the trend, as a regional financial hub, while it benefits from, global risk-off flows and increased local trading activities. And also we have the crowd favorite ST Engineering, which will, of course, benefit from Singapore's, sustained government spending on infrastructure and defense, alongside a somewhat booming aerospace segment. And of course, not to forget that ST's engineering exposure to tariff hit markets like China and ASEAN is somewhat limited, only about 3.5% of revenue. I think about 5% coming from profits coming from China. So a minimal exposure to countries like Vietnam, Thailand, and Malaysia. And losers wise, I think we are seeing news of course that OPEC is planning to accelerate their production increases, so putting pressure on oil prices. That's why we're seeing oil and gas prices like Pacific Radiance coming off today.
Zooming in on the companies to watch on the Singapore Stock Exchange today, David, we've got Keppel Core releasing an update for Q1 2025 today. If we look at net profit, that's an increase of over 25% year-on-year, driven by strong performance in its infrastructure, real estate and asset management segments. How would you read into the latest results?
I think this 25% I think was driven mostly by corporations. I think which is a good sign since corporations means you will exclude the legacy and oil and gas maintenance assets like Citrum, finance costs for vendor shares and contributions from Flotel, etc. And apart from that, we're also seeing positive growth from its stable infrastructure income and improving real estate contributions. And most importantly, I think everyone will be watching for its asset management business, which when it comes to the fee, I think we actually saw a 9 to 10% increase year on year. This portion is actually a bit lower than what I expected, given that this figure was around about 120 million to 137 million in second half of 2024, but yet we are seeing only I think 96 million for this latest result. So I guess we still take nothing away from it, as recurring income still make up a very strong 80% of group profit for now. And of course the market spotlight will also force on its divestment plan. I think Keppel this time has continued to do well, has divested about 350 million of assets year to date, and which I think is an achievement to them given current market conditions. And I think in its earlier call with analyst investors, management also guided that there will be about 550 million worth of assets. They are in advanced stages of negotiation and could potentially be divested over the next few months. So for that, we think Keppel is currently residing at a good spot for now, and with a dividend yield of 5%, it's a decent stock really.
And from Keppel Core, David, a lot of REITs have reported this week, and a lot more are reporting next week as well. So let's have a look at Mapletree Logistics Trust, because its distribution per unit fell 11.6% to 1.955 Singapore cents for Q4 on the back of lower revenue contribution from China and weak regional currencies. Very quickly, how far is that within your expectations?
I think if I look at the share price now from my screen, I think Mapletree Logistics Trust has fallen about 10% year to date versus 0.6 and 1% rises in the Azure Index as well as STI respectively. So interestingly, it's one of the stock that we have received the highest level of investors queries, asking us, why it's underperformed and what has the market price in at the moment. And I mean, our answer to them is that we believe the stock's huge correction is due to investor perception that it will be most impacted by the trade war, of course, and has therefore priced in a poor set of results. So with this poor set of results, an overhang is somewhat removed, but still, because of the ongoing uncertainty, I think markets still choose to sell now this stock today by around 4%. And I mean, if you look at some of its peers like the Groupman Group down under, Prologis in the US, and of course our own Fraser's Logistics Trust, they have all pulled back for sure. And with its portfolio of logistic warehouses across APAC, which previously benefited from the China Plus One strategy, shift from just-in-time to just-in-case supply chain and e-commerce penetration, some investors or existing investors have really expressed concerns about the impact of Asia, no longer being a manufacturing hub for the US, and the impact of incoming global recession. So we acknowledge that MLT is somewhat of a binary trade now, especially if we have a resolution of trade war. Its share price is pricing in a lot of bad news, but we think still it offers some long-term value, although there may still be further downside risk.
Okay. Now, if you're just tuning in, we're now in conversation with David Chow, Director at Azure Capital. Well, across the region, David, let's take a look at China. China's State Regulator and Planning Council published a new version of its so-called negative list, restricting the number of restricted industries from 117 to 106. Now, the negative list, the so-called negative list, specifies industries where activities by foreign investors are either restricted or prohibited. So the NDRC China's state regulator and planning council, said a number of areas have been partially liberalized, and that include television production, telecommunication services, online information services for pharmaceuticals and medical devices, among others. What implications will the move have on equity movements in affected sectors in China?
I had a long conversation yesterday, with a family office from Shanghai, and we're actually discussing some of the steps that China, has begun to take, to make itself a more, investor-friendly destination amid all this trade chaos. Casper, if you're listening by any chance, this is for you. So one of the things he said was that, China is now increasing its pace of, opening up the country, which is a significant departure from recent years. And even as the government recognizes that there will be some cost incurred in opening up, and perhaps to a certain extent they don't quite like it, but yet they have to do so because they really have to open up the market for a possible FDI. So I suppose this reduction of negative list industry in this list is a major way of doing so, and so as I've said, this move is positive for FDI amid a deflationary economic environment for China, which has been fighting deflation for close to 2 years now. So I think I would expect this move to perhaps be a long-term positive for the relevant sectors, but the devils will really be in the details. I will really have to assess, what are the clauses that the China government has inserted to these liberalization agreements, and how is it different from other countries in order to have a more, I would say, higher conviction, that this move is really substance over forms.
I think there are a lot of uncertainties going on with regards to not only China but also the US. And speaking of which, further away, David, the Trump administration is reportedly considering reducing tariffs on auto parts ahead of the May 3rd deadline that we talked about. And this is, of course, according to a report by the Financial Times. So sources familiar with the matter told the newspaper that the proposal would exempt car parts from tariffs that Trump has levied on Chinese imports to stop fentanyl production, and that the plan would also let part makers avoid tariffs for steel and aluminium, which is referred to as de-stacking. But when asked in the Oval Office if he was considering changes to auto tariffs, Trump indicated that he was not. He also suggested that he might even increase levies on the Canadian auto sector. For now, the White House has confirmed to CNBC that Trump is considering exemptions for automakers from some tariffs announced by his administration. But what do you make of this situation right now, and what is the outlook for the global auto sector?
I think in just a couple of weeks since the liberalization day, we have certainly seen a couple of flip-flops by Trump already.
Yeah.
I mean, from initially imposing tariffs, worldwide tariffs, to giving a 90-day pause, and from imposing port fees from China-built vessels to easing of port fees on the very same China-built ships, after receiving industry backlash. I think Trump has to be very careful of how he treads for sure. For the global auto sector, our own forecast for the global auto sector as a whole, at the beginning of the year, in terms of vehicle sales, we actually forecasted a 1.8 increase this year, followed by a 1.7% increase growth next year. But to be honest, the risks are getting, are weighing more and more to the downside, as tariff uncertainty really poses headwinds to global growth. And, the players in the value chain, such as the auto parts suppliers and even the car dealers, will of course be affected as well, even though we don't have explicit forecasts on this subsector. So at this present moment, we're still waiting a wait and see, but we are, increasingly, really the risk will be on the downside. So we will just be waiting for another major trigger before we actually forecast this for these numbers downwards.
I see. And before we let you go, David, U.S. earnings are due from Google's parent Alphabet. So again, what are you expecting given concerns over the impact of Trump's tariffs on online ad spend and, of course, the outlook of its cloud business? And how far will Alphabet's earnings be an indicator, a proxy of what is to come for other mega tech names like your Amazon, Meta, and Microsoft next week?
I think from our research, we have found that overall on ad spending, it typically, decelerates over 35 percentage points or from peak to trough over the previous few recessions, like what we have witnessed in 2009 and 2022. Currently, there are again a bunch of factors colliding all at once this year with the tariffs and with wealth effect potentially coming down, the curtailment of de minimis and China's e-commerce companies, outbound ad spending, and of course not taking into consideration, other second derivative recessionary impact post tariffs such as employment, wages. So putting all this together, assuming there isn't a quick about face turn from Washington, we can safely assume that any recession could mirror what we have seen in previous eras. And for that, all of these episodes are different, I would say, in 2009 and 2022, but they actually behave quite similar in certain ways. But again, we must remember that, digital advertising has a different category mix compared to the broader economy, and to make matters even more complicated, each platform, we're talking about Meta, Google, has different category exposure. So retail will be the most common one, and then, for case in point, will be travel and financial services, I think make up over 25% of Google search revenue, but these two categories are just like 12% of Meta's ad revenue. So you have to assess, different industry, of its own merits, and it could be very complicated. And on cloud spending, we actually did some survey with some of our overseas contact, and it seems that some of them, I think about 25% of corporates we have surveyed, seem to have decreased their cloud spending in their FY25 budget. So I think these customers are in industry, they are exposed to Dodge and tariffs, and in terms of country, we are seeing our contacts in Canada and Western Europe seeing a broad-based weakness, but our contacts in US somewhat, have held up well, except for a few verticals such as autos, and otherwise, other verticals such as financial and healthcare, they have showed little indications of slowing down. So having said that, I think we remain positive long-term on cloud computing as we continue to see more Gen AI applications moving from proof of concept to production. It was like maybe 5 to 10%, 18 months ago versus a high of 40 to 50% currently. And also at the same time, we are seeing more use cases for AI agents from vertical software players to horizontal use cases, that can go across software vendors and department functions. So with all that, I guess a lot of spotlight will fall on Alphabet as usual. Nothing will change.
Yeah, I see. Thanks so much for the insights as always, David. That was David Chow, Director at Azure Capital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.